What's up, everybody? Welcome back to the channel. We're getting back into covenants to help you get that money and also, too, to better understand your lending relationship. We're going to address a usual suspect that you see in loan agreements, used a lot in SBA, conventional lending. Pretty much every single banking relationship will have some type of cash flow covenant. And here it is, the good old debt service coverage ratio. Now, this one is more focused on an operating business. Real estate is a little different, it has some different calculations. I can do an example of one of those. I'll do it a little later, but figured I'd hit you with a good one here on the weekend to get into it. And yeah, let's walk through it. So, first, and again, before I start, this is the cash flow aspect of this, and this is very rough for cash flow purposes. And also, it's building, as you can see here, on our EBITDA calculation. And then there's a little difference down here, which I'm going to discuss, but this is essentially EBITDA again. So we're taking a rough cash flow estimate for operating cash flow, and then we're going down, and then we're also hitting the debt service coverage, which is on this side. But let's go through it. So first, you have your net income. Now, a little different. I'm kind of consolidating two steps instead of adding taxes back. I'm saying pre-tax net income. So your bottom line, pretty self-explanatory. How much the company made on an accounting basis on the bottom line. Next, we're moving down your interest expense, how much interest you paid on all your loan obligations throughout the period, your depreciation and amortization. Again, non-cash items. Pretty simple, straightforward. You know why you're adding those back, because they're non-cash. They're not really cash flow. They're just accounting metrics to handle the depreciation of fixed assets and the depreciation of intangible assets. Okay, and then also to, in some situations, you'll have another line that says non-cash items. These can be offsets like bad debt expense, which is when a customer of yours doesn't pay you back. There's a few other things, but we're sticking elementary here, trying to keep it as simple as possible. Okay, so now let's get into the weeds a little bit here. When your bank is looking at this, they are going to subtract out your distributions and or your taxes to pay the government. Why? Because you have to do it. You have to pay the government in order to keep the game going. So that's why they're taking taxes out here. Now, your distributions, now I live in Florida, clearly. There's no state income tax or local income tax, there's only federal. So a lot of people just run income through their personal, which is in an S Corp. We're getting into taxes again, but I wanted to understand why I tend to look at it this way. So the reason why you're subtracting out your distributions, your total distributions from the cash flow calculation, is that is money leaving the business. As a lender, I want to know how much money is left in the business to pay me back the lender. So I'm going to take out all the distributions. Some covenant definitions will have it where it says only distributions for tax purposes, and then you have to prove it out to them. But usually inside the machine, they're taking out your entire distributions, because once that money leaves the company, it's harder for the bank to grab. And as I've told you time and time again, what can the bank grab? The bank wants you to be just as invested in this game as they are. They don't want money leaving the business. And a lot of the times, too, they have good reason to tell you to keep it in the business. Maybe your business is creating a return on equity or a return on investment of 20, 30%. And they'll look at you and go, why are you taking money out of the business? Where else are you going to get a better return than in your business? And also, too, like I just said, they have a reason to want you to keep it in. So after we take all this, net it out, you have your rough total cash flow. So this is going to be the numerator in the calculation. And this is the rough estimate that banks are going to use to assess how much cash flow you have to pay your debt service, aka what you owe the bank. And so now let's go down those items here. So again, pretty self-explanatory with the first one. Interest expense, the interest you pay on your debt. That's a part of your total debt service costs. In order to service that debt, meaning pay the debt throughout the year, you of course include the interest expense. Sorry about that. All right, now we're moving down. We're getting a little nitty gritty here. So the next one, prior year current portion long term debt. So first, let's talk about why we use prior year in both of these. if you think about it, your prior year, of course, last year, but your current portion long-term debt is the amount of debt you're going to pay over the next 12 months. So what you're trying to do is you're trying to match the cash flows up to what you did in that year, and then also how much debt service you paid that year. So you're not going to use what's on the current portion long-term debt on the balance sheet today. You're going to use the last 12 months, because the last 12 months is what you paid over the last 12 months. So that's why we use the prior year. So current portion of long-term debt, pretty simple accounting term, pretty self-explanatory. This can include term debt, real estate debt. Lines of credit are not included in this. I would not include them on this. Typically, if you have a line of credit out to somebody, you're anticipating, especially if it's performing well, of renewing that line. So you would never, even if the line is coming due, you're not looking at that as current portion long-term debt. You're looking at it as a line of credit. So that is not included here. Just a little caveat there. All right, and then the final thing in the calculation, prior year current maturity of capital leases. And again, this is just another more broken down um, a more broken down version of your total debt service costs. So this is all of the debt that's associated with your leases to your equipment purchases. So also too, depending on what the this is very accounting in depth and everything, but depending on the criteria you have for that equipment and everything, it might be a capital lease, and therefore you add it back because you treat it like it's real debt. There's been some recent accounting changes with all of that where they're trying to bring more of those liabilities onto the balance sheet. Again, that's a discussion for another day. We're trying to keep it simple here. But your prior year current maturities of capital leases, again, it's just term debt on your equipment. Just keep it simple. And so if you tally all these up, you have your debt service, your total debt service, how much debt and how much interest expense you have to pay throughout the year. So there you go. There are all the components. And then what do you do? The most simple part of this whole equation, total cash flow divided by your debt service coverage. Now, depending on what type of deal you have, what type of relationship you have, what type of facility it is, what type of collateral it is, it's a range. And I should have put it in here. I apologize. But typically, if you get close to 1.00, the bank's going to start getting nervous. You get above 1.25, the bank's going to be happy. You get in that middle range, which I would argue is 1.15, you're pushing your luck, and the bank's going to start looking at you more closely. What I would call excellent, above 1.5. So that's kind of your range where you're playing. You always want to stay above 125. That's typically where people will put the covenant, because the bank wants to flag if your business is having cash flow um, issues early. So they're always going to put it slightly above where they're kind of break even. Okay, we need to start looking at this more closely. So like I said, they're going to keep it at that like roughly 1.25 or 1.35 range. And then if you break that, you're in default. But that's okay. Typically, you just talk to them and say, hey, this is what's going to happen. I'm going to make more money, et cetera, et cetera. But really, the bank is more looking for you to get below that 1.15 threshold. As soon as you start drifting close to 1, they're going to get very nervous, and they're going to start monitoring you more closely, monitoring you more frequently, saying, hey, I want your financial statements every quarter. Hey, give me monthly information. And then if you drop below 1 times, you're in a cash burn situation. I'm going to do a whole video on cash burn. But as soon as you drop below 1.00 times, you better be putting money into the business or have a great story about why it was temporary. So, yeah, so those are all the nuances of debt service coverage ratio. I'll hit on some more stuff with this maybe later on in some more specific topics on this. This is meant to be very elementary, very first layer. So we're gonna leave it there. Hope you enjoyed the video. Hope you found it interesting, insightful. Again, you can go online, pretty simple stuff. You can see this calculation. It's all over the web. I Googled it before I came out here. And yeah, take your financial statements, plug it all in, and you can calculate your debt service coverage ratio. And then when the bank comes to you and says, hey, where are you at on it from a debt service coverage standpoint, you can tell them. And again, this is a cash flow covenant. So this helps that one side of the equation. Hey, what is your leverage profile on a cash flow basis? You can use this covenant to help support your deal. So hope you like the video. Like, subscribe, comment, ghost follow, do whatever you want. Thanks for tagging along. Appreciate it. Talk to you soon.